Hello everyone, thanks for tuning back into my channel. I'm Tom Hernandez of the iMarket LA team here in Los Angeles, California, Keller Williams Studio City. Hey, today I'm going to be sharing with you a video call that I had with my senior loan officer, Michael Weisberg from Lend to America. We had a great in-depth conversation about the mortgage process and how it relates to the home buyers and even some home sellers. So stay tuned, it's going to be a great video. You know, the mortgage business is very complex. There's a lot of moving parts and a lot of little nuances to it. And, you know, with the right information for a buyer, especially when they're buying homes in real estate and getting mortgages for those homes, it's really important to kind of understand the process and how it can affect you. So stay tuned, here it comes. I hope you guys enjoy it. And at the end, if you find that you need some more information, please feel free to reach out to me or even Mike. We'll be more than happy to get that information to you. All right, here it comes. All right, guys. Hey, thanks for joining in. Today, I got the amazing opportunity to sit with one of my longtime friends and mentors, real estate lender, Michael Weisberg from Lend to America. Michael, how are you?
I'm excellent, Tom. Thanks for having me here today.
I appreciate you taking the time to meet with me and go over this topic. Today, Mike, I wanted to talk about the pre-approval process with buyers. What are the steps? Let's dive in a little bit into detail. So that way, I really want my viewers to kind of get a good sense of what it is, what the steps are, what's needed. So hopefully when they're done with this video, they feel like rock solid in understanding the process, and nobody better than you to help them, Mike.
Absolutely. Yeah, it's become very, very important to know upfront how much you qualify for, the steps in obtaining financing. You know, you fall in love with a property and you don't do the steps of the financing up front, you know, you get caught off guard. So we avoid all those things by step-by-step processes. Doesn't matter if you're a first-time buyer or you're buying your 10th property, it's the same exact process for everybody. And a pre-approval is, you know, people say, hey, I need to get pre-approved, but they don't really know what a pre-approval is.
So real quick on that, Mike, there's a pre-approval and a loan approval, right? There's a difference.
Absolutely. So pre-approval is generally a rough overview. You're looking at somebody's credit, you're looking at their income and some basic asset information, getting an overview and saying, yeah, you look like you're qualified. Versus an approval is your loan's actually going to an underwriter at the bank. They're looking at the income, credit, assets, and comparing them to the guidelines to make sure it meets the Fannie Mae and Freddie Mac underwriting guidelines, and it's an actual approval.
Gotcha. So what would be the steps for financing, like once an offer is accepted? So you mentioned that, yeah, in the beginning, you're going to turn in this basic income stuff to give you an idea that, yeah, you fit the mold. But now I've got an offer accepted. Is there additional paperwork, or we're ready to lock and dock, as we say in the business?
Right. So yeah, there is definitely. So, you know, we're scratching the surface with the pre-approval letter. We're running somebody's credit. We're looking at income and assets, looking at a debt to income ratio where we're looking at how much your payments are going to be in comparison to how much your income is. We're looking at several factors. When you're offered, at that point, we initiate a pre-approval letter that says we've reviewed it and we're comfortable and confident we'll be able to get you financing. Now go find a house. Now, Tom, you found them that house, their offer's accepted, and the clock starts ticking. It's a 30-day escrow. We got to close this. That's when we're gathering up everything else. It may be that we've already got pay stubs. We may need tax returns, W-2s, bank statements for 2 months, copies of their driver's license or passport. So there's several more documents that we gather. We then complete a loan application. Now that we've got a property address, we can complete a loan application with that property, with a final purchase price and an exact loan amount based on that purchase price. And that's when we are able to submit it to the bank to get a full formal loan approval.
So in the pre-approval process, could a buyer do that extra stuff in advance? Would that make them even stronger for you to turn in that extra stuff? So kind of just to recap, the pre-approval could be just the basics and then turning in this stuff once an offer is accepted. But if you wanted to take that extra step and do these pay stubs, tax returns, copy of driver's license in now, that's only going to make your process a lot faster when we find a property.
Highly recommended, especially in this competitive market where you're getting people with cash offers coming in and you're doing financing. We highly recommend getting full loan approval with a property as a to be determined address. So we plug in a higher price. Maybe they say we're looking at properties at $600,000. So we might push it at $650,000 or $700,000 purchase price to give them a little bit of a comfort room in case there's, counter offers and prices go up. But we get that loan fully approved. And the benefit of that is now you can write an offer with no loan contingency, which is like a cash offer because there's no loan contingency. You may still have your other things that you may need for home inspections and other things that are going to be a need to review. But on the loan, that stands out to the seller that, hey, Mike with Lend to America has got this loan fully approved. And Tom's writing an offer with no loan contingency. It's huge. And it doesn't take that much more from what we've already done. If we've already collected the basic stuff on a pre-approval, it's a few more pieces of paper and some signing of disclosures. There's no commitment. There's no cost. Doesn't cost anything for us to run your credit or to get your loan fully approved. There's no upfront fees involved.
I mean, in my experience in business in doing that, a lot of times when I'm the listing agent and I get these pre-approvals and then the buyer starts to submit this stuff is when all the little nuances of unreimbursed expenses come out of the tax returns and the lender didn't get this till late in the game. And now all of a sudden you're finding out that they're not as qualified as you thought they were. So doing these extra steps of turning in your tax returns so that you could really dive into them and look at them as what are they filing with the IRS can make a big difference. Yeah, Mike, I mean, I'm sure you've had some nightmare stories of pre-approval letters and then getting documents and scratching your head going, oh no, how do I handle that one? Right.
And for us, it's highly encouraged. Just go in, get the approval up front. The home buying process is the single biggest transaction of somebody's life. And the loan process can be a very big stressor for people. We see, many times it happens with lenders that they'll submit a loan and then it'll be like, well, we need additional documents and we need additional documents. And there could be back and forth several times. And for people, while there's so many pieces, it's not just like when you're in escrow that you're just doing the financing. Well, you've got home inspections that you may be doing. You may be starting to think about moving trucks and all these other steps. There's a lot of things going on. That's a lot. If you can get that loan approval piece out of the way and most of those steps already done, it just sails through the system. It's a lot easier. Yeah, I'm so glad that you touched on that because I can't tell you how many times the clients run into my office, scan this, Tom, Mike needs this, and or lender needs that. And it's like, we're working on a home inspection over here and you're scanning docs like, wait a minute. So yeah, right. I definitely agree that I'm glad you shared that point of view. To deviate a little bit off of that, but kind of something that just popped in my head was, you hear a lot of lenders talk about underwriting time I'm running 6 days in underwriting or, share with us, Mike, how what is with that? Why like I've never had that issue with you. Right. So, I mean, with us, in most cases, we're next day loan approval. So if I sit down with that client today and they've got all their documents and we sign an application and I've got all the income and credit and assets and everything I need, and it goes into underwriting today, by tomorrow, I have full loan approval.
So
now, most lenders don't have that because you say, could be 6 days. It may be, with some of the bigger banks, we see that there's a lot more steps in the process. In buying a home, there's a lot of people touching the system. It's not just you and me, Tom, but there might be escrow officers, title companies, inspectors, appraisers, a lot of people. And in the banking part of it, just in the financing, you may have 10 or 15 different people in the loan side of it alone, with opening the file and processing it and an appraiser and all these different things. What we do here at Lend to America is we try to reduce those a number of steps. So we'll take 4 or 5 of those steps that would get divvied out by multiple people, and we'll give it to one processor. And that one processor will handle more. And that's why we're able to turn in a loan today and get it right into underwriting the same day versus somebody that opens a file, that moves it to an opener, then to a processor, then to an underwriter. We've skipped like 3 steps. I mean, the steps are still getting done, but they're getting done by one person.
yeah.
We have a lot more training. We have a lot more educated people doing those steps to get it through the system. Less people touching, less mistakes, and quicker.
As a listing agent, sometimes my worst nightmare is when I see a pre-approval letter come in from like an online bank, because their underwriting is in Colorado, their doc department's in Michigan, and their funding is in Oregon. Right. And the right hand talks to the left hand in different time zones, and you find that they it's just, you're losing so much time. And when you have contingencies in a contract where you just signed as a buyer that said, hey, Mr. Seller, I'm going to tell you in 17 or 21 days if I can get you a loan, it's more critical to go with a lender like you, that you say that I'm condensing all that, we're doing all that stuff in-house, right, so that you're not having to worry about that stuff. So I think that's a valuable thing that you offer, and are the reason why a lot of mortgage business and home purchases are done through Lend to America and companies like yours. Yeah,
sure, absolutely. And for us, we operate just like the biggest of the biggest banks. We're a direct lender. We fund our own money. We have our own appraisal management company with our own staff of appraisers. So you've got the same exact benefits. Our rates are as good or better than the major banks, but because we're more of a boutique setup, we can turn things a lot quicker than them. So on servicing levels, they're never going to be able to put in a deal and say, hey, we want to go into escrow, but in order to do this, we need to close in 2 weeks. For me, I could say we can do that. On some of these other institutions or an online lender, there's no way they're going to do it in 2 weeks. They're going to be 30 days at best, and sometimes 45 days. For us, we pride ourselves on being local, which, being here in the San Fernando Valley is a big benefit. We know the markets. We have local appraisers that are familiar with the properties in these cities. So those things are all a plus. I mean, if you get some, no-name lender online because you thought their rate was so good, the challenge is, and we hear this all the time, hey, I went online, I did some search, no-name lender told me he can get me this rate. Now, we know the rate is not there. It's not even close. But the clients are like, but they have to offer me that. They quoted me that rate. They have to give me that rate. Well, not really, because they may quote that, but they may not be telling you how much in fees you're paying to buy that rate. There might be multiple points in buying that rate.
right.
For me, I always say my client is you, Tom. The borrower is the borrower. I'm helping the borrower, but you're my client. We are repeating doing business. You're my client. You hand me the deals, and I got to make sure I deliver on time every single time without failing. Otherwise, you don't look good to your clients, and you want to get repeat business from them. So I make sure that I'm doing that work that's needed up front to avoid those issues.
Yeah.
And the bigger guys that are online that are quoting some low rate just to try to get them in the door, they don't care if it takes 3 weeks and at the very end they surprise them with, hey, I'm sorry. Yeah, well, that rate really is going to cost you this many points, or I can offer you this rate with no points, which now it's the same as what we were offering, or higher, but they have no choice but to go through the deal because they don't have any time left. There's only a week left to close. You can't start the loan over, and now you're stuck.
Yeah.
And it's the worst type of business. I've been doing it 30 years, and unfortunately, there's a bad rap out there because I see it happen time after time with no-name lenders just working one deal at a time. For us, it's a relationship, many deals, many years working together. You can't do business that way.
I agree. So let's talk about closing costs. How much should a buyer estimate for closing costs? Is there a formula that you guys use, or because like you said, you don't know what the points are. How does the consumer, how does the buyer get a grasp on that from the loan side?
Right. So there's two ways of doing it. There's a real ballpark rough estimate. If somebody's like, hey, I'm buying a $500,000 home, regardless of down payment, what are my closing costs? And you might say 2%. Now,
That's
is
typically
2%?
what I'll say.
Yeah. Now that's a real general. That's $10,000. Now there's a lot of pieces in that number that can change one way or another. Maybe they're saying, I don't want my property taxes and insurance included in my monthly payment, and we're not going to collect a reserve on that. That could be a significant number. Maybe in the deal, the seller is giving a credit towards closing costs of $5,000. So really, maybe all their costs is $5,000 they're bringing in. So there are some variations. What we do is what's called a loan estimate. So right when we go into the deal and we do the loan app, we generate a loan estimate that gives a breakdown line by line of what you're going to pay, from the loan fees, title fees, escrow fees, everything. It gives you, here's how much you need for your down payment, and here's how much you need for your closing costs, with a grand total, how much to bring in. And that number and how we do it and how it's supposed to be done will never be higher in the end. As long as the price doesn't change, at the very end, that number will be there or less. And what I can tell you is, in how we do it, the number is going to be less at closing, because we're going to give you a little bit of a cushion, a pad, when we do that loan estimate, to make sure we've over disclosed so there's no surprises in the end.
Gotcha. Let's help the consumer understand points. Points are how much? Like, you hear, oh, this is at 0 points, or this is at 1 point. Well, how much is a point?
Sure. So a point is generally, it's 1% of the loan amount. So $500,000 loan, 1 point, 1%, meaning $5,000 is your point.
Should a buyer always pay points?
It depends. So there's a few factors that'll go to that. So most of the time, I would say probably 90% of the time, we do it with 0 points. The only time that it makes sense is if somebody says, I want a lower rate and I'm willing to pay a point to buy my rate down. Now, it's not a direct correlation. It's not like you pay 1 point and you get 1% lower.
Oh, that would be amazing.
It'd be amazing. The ratio may be you pay 1 point and you get an eighth or 1/4% lower in interest rate. So somebody may look at that on a $500,000 loan and say, that point is $5,000, but I'm only saving $50 a month by paying a point up front to get that lower rate. Well, that's going to take 100 months to recoup your closing costs. That's a long time. I might not
even own that house anymore by the time I pay that house off.
Right. So my general rule of thumb is, if you can recoup your costs, your point, 2.5 to 3 years.
Okay.
So if that was, one point being $5,000 and I can save, $500, that's 10 months. That's great. And those percentages, or $250 a month is 30 months. That makes sense, because you recoup time. But then we're going to look at some of those other factors. Like you said, I might not be in that house. So if somebody says I'm buying this house, but I only plan to be there 2 or 3 years, it doesn't make sense to pay a rate to buy it down. If somebody says, this is my forever house, even if I was to move, I would keep this house and turn it into a rental. I'm not going to ever sell it. I'm going to pay this thing down. Okay, great. Then maybe paying a rate, buying down the rate makes sense at that point.
That makes sense. So closing costs in general then are going to be title, escrow, recording fees, loan fees. What are loan fees? Typically there's, I know there's like underwriting. What are the typical loan fees that would be standard on every loan?
Sure. So on loan fees, there's a processing fee. So us putting all this paperwork together in our staff, there's a processing fee. That's about $695. You're going to have an underwriting fee. As we said, sending that loan to the bank and the underwriters are reviewing it. That's about $775. And then the other fee is $350, which we call our funding fee. That's for preparing the loan docs, sending out the wire to the bank to fund the loan. So you're looking at, that's a total of $1,820. So to come to us to do a loan with no points, it's costing you $1,820.
So 3 fees should be the norm: an underwriting, some type of doc fee,
And a
processing fee. So if a consumer is looking at a loan estimate and there's more than 3 lined up on the loan side, somebody's making a little extra cash there.
So one of the ones that a lot of people don't realize is some lenders will charge what's called an application fee. And they'll charge money up front for that application fee. Hey, it's a $500 application fee to get started. And then they may change their mind after they get all the numbers and say, you know what, this loan I don't like, I'm going to go somewhere else. That application fee is non-refundable.
Wow.
So a lot of people don't realize that if they're paying money, if they go to a lender and they say, we need money up front to start the loan process, run. Run, don't walk.
Yeah. And what if you got denied? You just spent $500 to have the lender tell you that they didn't approve you.
Correct.
That'd be bad.
Yeah.
So Mike, you touched earlier on, and I know maybe some of the watchers on the channel may have not heard it, but you mentioned Freddie Mac and Fannie Mae. Yeah. Tell us a little bit about that.
So Fannie Mae and Freddie Mac are the 2 main institutions that guarantee the loans. So something like 80+% of all loans that are closed in the United States are secured or guaranteed by Fannie Mae and Freddie Mac. Doesn't mean you're making your payments to Fannie Mae and Freddie Mac. You're going to make your payments directly to the bank. But if for some reason you stop making your payments, go into default or something, Fannie Mae and Freddie Mac are going to insure that loan with the bank because it met certain criteria. So Fannie Mae puts into their guidelines, and Freddie Mac, and they have very similar guidelines. There's a few little differences between both. And we as the lender decide where that goes. And if it's Fannie Mae or Freddie Mac, the buyer never chooses that. We choose that for them. And it says, we need 2 years of tax returns or 2 months bank statements and a current pay stub. It may say there needs to be a minimum credit score of 680 or whatever those numbers are. They'll give us these guidelines, and then the bank underwriter underwrites to those guidelines. As long as that loan meets those guidelines in the end, Fannie Mae and Freddie Mac will insure that loan to the bank.
So that's really the big the big reasoning why there are these guidelines and why the underwriters are looking so closely at them is to make sure that Fannie Mae or Freddie Mac will insure that. Because if they won't insure it, then the lender gets stuck with that loan, right?
Right. So we call it a qualified mortgage, QM. Qualified mortgage means we went through all the steps to make sure that that loan met certain criteria. And that qualified mortgage is going to get the person the best of the best rates, the best terms possible that are out there. You're not going to get a better rate in terms than Fannie Mae and Freddie Mac type loans. Okay, other than maybe a government, an FHA or a veterans loan, which are similar. But Fannie and Freddie is going to get you the best of the best. Otherwise, you go non-qualified. So there's qualified mortgages and non-qualified mortgages. A non-qualified mortgage, maybe it's something doesn't meet, the income requirements aren't met, or the credit is not met. There may still be financing options out there, but not at the same great pricing that Fannie and Freddie is going to offer.
So they won't underwrite to those guidelines. They're going to go in a different direction for underwriting, and a different bank is probably going to want to pick that loan up and service that loan.
Exactly
Gotcha.
Correct.
So would I be correct? Because, you know, I get this all the time when I talk to buyers and stuff like that. Oh, I talked to this guy, you know, he said because my FICO score was X, he wanted to give me 3.9 instead of 3.5, or I hadn't been on the job. And I mean, am I right to say if you meet these qualifications, you should be getting that prime rate? Like, that's really
Absolutely.
not an accurate statement that they're telling the consumer. If you got a 680 FICO and you've been on the job 2 years and your payment's 33% of your monthly income, you should be getting 3.125. There's no reason why the lender should be telling you, oh, you're a 3.75er.
Exactly. It's you can compare it to what a lot of people have done is buy a car and finance a car. You go in and buy a car and they'll sell you on the payment. Hey, this car is only going to cost you $500 a month. And you're going, hey, I can afford that. But what you don't hear is, but that rate's at 9%. Versus you go to another dealership and they say, hey, that payment's only $400 a month for the exact same car. And why is that? Because they're giving you an interest rate of 3% for that car.
Right.
So they're selling you on a payment of what you can afford. So we see that a lot in this business, that they'll be like, hey, your payment's going to be $2,500 a month for this house. People are like, that's great. And they're not looking at the interest rate when their payment might only be $2,000 or $2,100, and they should be getting a lower rate. If you've got good credit, you meet all the criteria that Fannie Mae and Freddie Mac put out there, you should be getting the lowest possible rate. And
now, what would be the advantage to a lender to give somebody a higher rate? Like, why wouldn't they want to give them 3.125%? And
it's the greed factor, more money. So look, in the banks, even if you're not charging points, the banks pay a premium on the back side of that loan. And the premium goes higher based on a higher rate. If you have that loan, Tom, I give you a loan for the next 30 years, and I give you a rate of 3% versus a rate of 4%, I'm making less interest on the life of the loan of that loan. I'm only making interest at 3%. But hey, if I give you that rate at 4% over the life of the loan over 30 years, that might be another $30,000, $40,000 you're paying in interest over the life of the loan. And if that's 30 or 40,000, they might give a loan officer a piece of that. They might say, here's an extra $5,000 or here's $7,000 because you're making more money for us by selling a higher rate. And we love that, is what they're thinking, the bank being think of it like Vegas. They want to win. Banks aren't in to lose, they're in it to win. But there's a level of what's right and what's not. And that's where we talk about predatory lending, where people are preying especially on first-time buyers, people that may be of immigrant status that don't have the savvy as somebody that's bought their second and third home. And there's people out there that'll take advantage of that. And it's a predatory lending. It's against the law. It should never be done. People can go to jail in the lending business by doing that. And so we fully show people the rates. We're happy to have them compare our rates with other institutions out there and see what they're getting so that they know they're getting an accurate, good deal.
So then it would be fair to say when you're charging a loan with no points, the fees that Lend America is making, or the income that you're making, is on the doc fee or the processing fee, and then some type of rebate pricing, as they call it, from the lender based upon the rate that you quoted.
Right. And us, because we're a direct lender, we get a servicing value because we're actually lending the money versus a broker is a middleman. So when you're dealing with the bank, we're the bank, think of it that way. We're doing the loan. If there's a broker, they're in between the bank. And once they close that deal, they're out of the picture. So they have a higher incentive of trying to push rates higher to get something. Us, we're getting it as a servicing value over the life of that loan, and we're getting a piece of it. So it's a little different when you're working with a direct lender like Lend to America versus a broker. Because
so a mortgage broker is going to come one time, get his little piece of commission or rebate, and he's gone.
Correct.
You're going to be able to offer more of a premium rate and make a little bit more along the term of the loan that way.
Exactly.
Makes sense. So what else goes into a loan? Like personal information? What else? I mean, I always tell my clients there's three things that qualify you for a loan. There's your credit, there's your income, and then there's your collateral. Yep. And they always say, what do you mean collateral? And I bring up the appraisal process. Why? What else goes in there? I mean, why appraisals, or why are they so important in the loan business?
Sure. So the bank wants to make sure that the asset, being in this case the property, is what it is. So you say the same example, a $500,000 home. We want to make sure that house is worth $500,000. Now, how do we know? Well, we're going to send out somebody to look at it. They're going to take photos, look at the condition of the house inside and out. They're going to measure square footage, make sure the number of rooms matches what's in public records and everything else. They're going to make sure that there's other homes in that area within a half a mile or a mile radius of that house have sold in the last 6 months in that same price range. So that way, then we make sure that the person that's buying that house is not overpaying. And then from there, as we've seen, sometimes, appraisals may come in less than a purchase price. And the bank is then going to say, you've got a couple options. You can either go back to the seller and see if maybe they'll lower the price. Or if you're okay with the price and you have enough money in the bank, you can bring in that difference. So you can come in with that shortfall and make up for it and buy it. But at that point, then we're going to have the buyer sign something that says, I acknowledge the property didn't appraise. I'm okay with it. And I still want to buy it. And I'll bring in the cash to make up the difference. Because we want the clients to make sure they're fully aware of what's going on.
Gotcha. And in some cases, you've actually seen where buyers said, well, I was going to put 20% down. I'll just put 10% down now, and I'll use that difference to make up some of that shortage in the
Sure.
So at the end of the day, they still spent 20%. They still spent $50,000 or $100,000 in a $500,000 purchase. They just put 50,000 down, and then they use another 50 to cover the shortfall, like you said.
Correct. So it changes the loan to value. Instead of an 80%, it might be a 90% loan to value. There's different structures that we can try to do in multiple different ways in that. And it may be a combination of the seller coming down a little bit in the price, the buyers coming in with more money, and, it could be even realtors and whatever else. There's so many different options that people come up with to figure out a way to make a deal work. So there's multiple avenues. It's not just, hey, it didn't appraise and it's dead. Now, that is a final option if they have an appraisal contingency, and at the end of the day, it just doesn't work. We can't get a price reduction. They don't want to come in with, or don't have more money, all those things. With an appraisal contingency, that seller, that buyer can back out then, of the transaction and get all of their money back of their earnest money deposit. They'll be out the cost of an appraisal, but hey, being out $400 cost for an appraisal is a lot better than being out $10,000 price, on a pricing difference or more.
Makes sense.
Some of the other things that you were asking though about some of the other personal items that go into that, so we talked about appraisal. The big thing is title. So people go, what's title? Title insurance, what insurance? It's like car insurance. No, it's different. So title insurance, we want to make sure that the property they're buying doesn't have any loans or liens against the property. Somebody might have a collection or a judgment that got tied to the property. So when we get title insurance, they're guaranteeing that when that buyer buys that house, they're free and clear of any prior encumbrances. If something pops up 5 years later that was from the seller of that house, the title company has insurance. They will pay or do whatever need be to get that removed because they've given you that insurance that your property is free and clear of any liens. It's going to show a lot more than liens, though. It's going to show if there's easements on your property. You may have an easement for the public utilities to come on your property to check the gas meter or the water main. So there's a lot of things that this title policy involves, and a lender requires it whenever there's a loan. It's a requirement. Lender's title insurance is what we call it.
Gotcha. So my loan's approved, everything's looking good. What typical would be some extra documents? Because and I'm sure you get this, or you may not hear, but I get it. Mike just called me and said, I need this and this and this. I thought I was done with this. Let's prepare our viewers now for that on what would be typically asked after the loan's approved and why.
Right. So when we say approved, we say approved with conditions. Congratulations, your loan is approved with conditions. So let's say, for instance, we send in the full file, we send in a credit report. The credit report may show, it's going to show former addresses of where you've lived. Okay. So we put on the application that they've lived at ABC address for 3 years. But the credit report may say there's an address that they lived at in the last year. So now the bank is going, well, wait a minute, that's different than the application. Do they own another property? Did they live somewhere else? Did they co-sign for somebody else? It starts asking questions. So one of these conditions the underwriter is going to ask is a letter of explanation regarding that address. It may just be as simple as, oh, that's a former address that I lived at 3 years prior, or, oh, that's my parents' address and I don't own the property. It can be some very simple conditions. It could be questions about income. We've got your pay stub and your tax returns, but your income this year looks to be a little lower than last year. Why? Oh, I had a baby. Maybe you're out on maternity leave for a month or two. Maybe there was an illness. So we're going to ask these things to see. I mean, they want to make sure that, oh, my job got reduced and I'm making less money. That's a concern that the bank's going to look at. So they're trying to minimize risk. We try to cover as many of those things up front when we submit the loan, but there is always something that may come back very minor. In many of the cases, it's a letter of explanation. Maybe they had a large deposit on their bank statement. There's a $10,000 deposit, but nobody said anything about it. Well, that has to be documented and sourced. Oh, they got a gift. Okay, great. Or they sold a car and they got this money. Great. Then just give us the bill of sale so we can show the documentation. A lot of things have come in after, and after this weekend, 20 years later from September 11th. So there's a thing that's come out called the Patriot Act. And this is where we now do a lot more checks and balances to make sure things are not terrorist related things in financing. And that may be illegal money in their account or illegal activities. Us as a lending institution, we have to make sure that everybody's complying with these rules and regulations. And so it's become a little bit more. We try to make it as painless as possible, but for the viewers, please understand, this is something that's protecting the greater America and the United States from future harm. We try to make sure, things that we see, that we can bring it to whoever's attention.
So something that just made me think of, and I think I'd like you to touch on, is in your loan approval, there's prior to doc and prior to funding conditions. Most loan approvals come with a combination of those. Share with us a little bit how that works and what and the dynamics of that, so our viewers can really be informed borrowers.
Sure. Yeah, so prior to doc, what is docs? Well, loan docs, that's the official loan paperwork, notes, deeds of trusts, all of the official documents. Just like when you buy a car, they have you go into the finance department and sign a bunch of paper. Well, that's the same thing here. When we get loan docs, you sign in front of a notary, verifying your identification that you are who you are, and you sign paperwork. So we have those prior to doc conditions, which we talked about, letters of explanation. And then there's prior to funding. So you've signed your loan docs. You think, hey, I'm done. I'm going to get the keys. Well, it's not that simple. You sign the documents. It goes back to the bank. They now make sure that you wired in your money. So a prior to funding condition is borrower to wire in $100,000, so they're closing funds. That's a prior to funding condition. That we have our final title insurance policy, that all of the paperwork that was signed was properly signed. So those are prior to funding. Most of those prior to funding conditions goes back to the lender or to the escrow company or the title company. Generally, there's very little that the borrower at that point has to be concerned with other than bring in your money. And when we funding is we send out the wire to escrow for the loan. And that's when the next day, generally the following day, we do what's called recording. Recording is the official thing where they record the deed of trust, with the county recorder's office and put a stamp on it. At that point, when it's recorded, it's yours. It's done. It's over. They're calling you, Tom, to say, where are my keys? When do I get them?
So recap: prior to doc, prior to funding, prior to doc conditions are probably going to be an updated pay stub, an updated bank statement, maybe proof a car loan was paid down, or proof that their deposit hit the escrow account. And then prior to funding conditions are going to be the last minute things that they may not have to deal with, but the lender's doing it, meaning, hey, proof the fire insurance came in, proof their deposit wire hit, and things like that. And sometimes those things take a couple of days to happen, and you have your loan docs out, or trying to get docs out, but you've got these prior to funding document conditions that still have to go back to the underwriter and get reviewed, and may take a day or so. So the borrower has to know that Mike calls out loan approval, and it's not, oh my God, tomorrow we're closing. No, there's still a couple little hurdles that may have to happen. I may need to get a bank statement and a pay stub, photocopy it, send it to the underwriter. Underwriter missed it today. He got it tomorrow. The next day he cleared it off, and now I'm ready to go, right?
It can be sometimes a couple days later, absolutely. So just because you signed your loan documents, we see it as soon as sometimes people sign loan docs today, and it funds the same day. The prior to docs are done, the docs are signed, the prior to funding conditions get done early enough in the morning, and we fund that loan that same day prior to 1:30 or 2 p.m. our time, because when we fund a loan, we don't go past 2 o'clock. And the reason being is it's 5 o'clock on the East Coast, and all wires go through the Treasury Department in the East Coast, in DC. So, and that's the same with everybody. If you wire money out of your bank today and you're sending your wire of your closing funds to escrow and you do it at 3 o'clock in the afternoon, it's not going out until tomorrow.
Right.
So for us, if we're going to fund that loan, we got to do it by 2 o'clock today. But it could be a couple days later. You signed your loan docs and we still need a few days. What we try to do most of the time is you're signing your loan docs a week before closing. And we're just sitting back that they've wired their money, they've done everything. So there's no delays. So that when that date comes up that we're supposed to close on Friday and we sign loan docs on Monday, it's no issue. We're ahead of the game. The last thing you want to do in this business is wait for the last minute to try to rush it through and make it happen. That's when the moving trucks that are sitting there waiting, things get messed up and they're like, well, wait a minute, I got moving trucks and everything for Saturday and something didn't happen. We want to stay ahead of the curve and avoid any of those issues.
So I'm a borrower. I get the call, my loan docs are in escrow. What does that mean?
So, well, it's a good thing. So,
Yeah.
It means you're really close to the end of the finish line and getting the keys to your house.
What do I expect as like, are they going to take blood or,
No blood samples, no nothing. But what they are going to do is they're going to say, so the escrow calls you up and they're going to say, we have your loan documents, which could be 150 pages of papers that need to be signed. Some need to be notarized with a public notary. So they will call you up. They'll set up a time. They may even come to your house to sign up the paperwork where you don't even have to go to an office. They'll come to your home in the evenings or on the weekends around your schedule to do that. They'll verify your identification, make sure who you are, have you sign a notary book. They'll even do a thumbprint to verify your identity. And then you're going to sign paperwork, plan on maybe up to an hour to sign the paperwork and go through everything. And then when you're done, they're usually going to give you a sheet of paper that says, here's your wiring instructions. And take this to the bank and wire your final money for the remaining down payment and closing costs. This is how much you need. And then you'll take that paper to the bank and you'll wire your money from your bank to the escrow company for your final funds. Then it's just a timing. So we may sign loan docs on Monday, but the seller may be moving out and you can't close until Friday. Maybe the contract says we don't close until Friday. So we're just sitting back at that point. Everything is done, everything's fine, and we're just waiting for that time to be, coming up.
And there's still things going on behind the scenes there too, because I signed my loan docs and I'm running out to the bank to go get my wire, but those loan docs are still going back to you for review.
Yep.
And sign off. And hey, you dotted all your I's and crossed all your T's. The notary stamp looks good. Title's got the documents they need for recording. You've got what you need to put in your file. There's other things going on kind of simultaneously.
Absolutely. I mean, it may be as even a final walkthrough. Maybe the client wants to go see the house to make sure that now that they've moved out, the condition of the property, their final walkthrough. So even though the loan docs may be signed, and even though they may have put money into escrow, we're not even funding that loan yet until you and the buyer have agreed that everything is how it is, and you're okay, and you've signed off, the final paperwork to say, okay, we take instruction from the buyer ultimately, because if they say, I've changed my mind. I don't want the loan. Even after they sign paperwork, they may be able to do it. There may be consequences of money at risk, but we're not going to close a loan if they say no.
Right.
So, but yeah, there is a lot of steps in the background that are still going because that paperwork comes back from the notary. It has to go back to the escrow. They have to certify certain documents. They have to send certain paperwork down to the title company for recording, certain paperwork back to the lender. They have to give us documentation that their final money has come in for the down payment and it's in the account and all good. So there is still a lot of steps. That's why we said there's a funding fee of $350 because there is a funder that is going through all of these prior to funding items to make sure we're good.
I think we should also let the consumer know, or the borrowers that are watching today know that money that has to be wired in has to come from the accounts that you guys verified.
Right.
You can't go to Uncle Joe and hit him up and say, hey, I funded it from Uncle Joe's account. Part of your auditing is making sure that money showed up from the accounts that you told the underwriter it was coming from, correct?
Absolutely. So it's got to come from the sources we verified. If the intent is to get a gift at the end, we don't do that. We know about that up front, and that's what it is. If you say that you've got money sitting at ABC Bank, we want to see a bank statement that says you've got X amount of dollars in ABC Bank, and those final funds are wired from ABC Bank. Otherwise, we get into other.
Yeah, I just had a thought right now. I think a lot of borrowers kind of relate home buying as like buying a car almost, in the sense that, hey, my dad's going to co-sign for me for a car, is a lot different than a co-signer for a house. Like, I can co-sign for the car and they're really just using, my credit scores to help validate my son, let's say, to help him get this car, or my income. Right. But it's way different, a co-signer for buying a house, right? I mean, there's occupancy issues. Yep. and the debts that go along with the co-signer.
Absolutely.
Talk on that real quick.
Yeah, of course. So if you, let's say that you may need a co-signer to help you qualify for buying a home. And that co-signer may be that co-signer may
Is that our time limit, Mike? Did you put a time limit on me?
I don't think so.
I love it.
That co-signer may be a relative, a parent, and they're helping you qualify. So they may say, I'm not planning on living there. I already own a house. Your parents are co-signing for you. They live in their own home, but they're using their income, their credit, and maybe their assets to help you get into that home. They are an equal borrower. Don't think of a co-signer as they have a less stake of interest in that loan. They are as responsible as the person that's living in the house. And they will stay on that loan until one of two things happens. They either sell the property or they refinance the loan. Once that loan gets paid off, then they're off of it. But until then, they're equally responsible. Now, it may not affect their qualification, because we get a lot of times of, hey, I'm willing to co-sign for somebody, but I want to buy my own house. How's that going to affect me? Because now I'm going to have a mortgage on my credit. So generally, they want to see 12 months of payments made by the person living in the house to exclude it from the other person. So if mom and dad co-sign for their kids, the kids are there for a year and the kids are making the payments directly to the bank on their own, I can exclude that mortgage payment from the parents' qualifications on a future house the parents may want to buy.
So, but also some co-signers might do more harm than good, because when you look at dad's 2 car payments, dad's $700,000 mortgage, he doesn't have any extra income to really help you in some senses, right? I mean, you've seen that.
Sure. Yeah, sometimes, it depends on what we're looking at. from that person. I mean, sometimes it may be that it's just assets that they're going, well, I was thinking about getting a cosigner because I don't have the money for the down payment, or I don't have the money for the closing costs. Well, now, most of the time, for a primary residence that you're buying, that money can be a gift. So if mom and dad want to give you money as a gift for the down payment, that's allowed, and they don't need to be on the loan.
Gotcha.
So there are certain things that can help without being a cosigner. Generally, cosigning, the main reason is there's additional income is the biggest reason, because credit is still based on, let's just say somebody goes, I don't have the best credit. I got a 650 credit score, but I'm going to add mom and dad, they've got a 800 credit score. Well, they still go based on the lower credit score. So if the borrower's at 650, it doesn't matter if the parents are at 800. They take that lower credit score of 650. So really the benefit comes on those debt to income ratios. If the numbers are a little bit too high, maybe the home price is a little bit higher, and maybe their income is just not where it's going to be in 12 months from now, and they need somebody to show a little bit extra income to help them qualify, that's when we see a cosigner.
Gotcha. All right, so let's start getting ready to wrap this up. I've closed escrow. When is my payment due, and who do I pay it to?
Very good. So exactly. So
Or do I get no payments for 90 days, right, Mike?
No, but you get sometimes no payments for 30 days. So let's just say we're in the month of September. And when is my first payment due? So we skip a month. So you'll skip October, and November 1st would be your first payment. So people go, well, wait a minute, am I really skipping a month? And it's no. So let's do a comparison. If you were renting for the month of October, you'd pay October 1st for your rent.
Yeah.
In a mortgage, we call it paying interest in the arrears. So your October payment for your mortgage and the interest for the whole month of October is due November 1st. Your November 1st is paying for the interest of October. So we closed in September, but I said your first payment is until November. Okay. So in September, let's just say there's 2 weeks left in the month of September. At closing, we're going to collect 2 months of interest for the remaining days in the month of September. Skip October payment, make your first payment November, and November is really paying for October 1st to October 31st of interest. Now, when is that payment actually, when are you going to get a notification? You're going to get either one of two or both. You're going to get an email saying, congratulations on your closing. We're servicing your loan. Here's your loan number, and here's how you can make your payments. And it'll give you options to pay online, or by mail, or an auto debit out of your bank account, auto bill pay. It'll give you those options. And then there's the, and that usually is about 2 weeks after closing. So we close September 15th, let's say. By October 1st, you're going to get a payment notice saying, here's where to make your payments. And it'll tell you again how much. Now, in your loan documents that you sign is a first payment letter. And it's going to tell you how much that payment is up front. And it'll probably tell you who the payment's to make it to. But you're going to get something in the mail more formal and official to remind you about 2 weeks after closing.
Gotcha. So if I closed escrow September 17th, in escrow, they're going to take interest from the 17th to the end of the month and bill me that as part of my closing costs.
Correct.
So that way in November 1st, they're going to charge me my mortgage payment, but it actually represented the interest of October 1st to October 31st. And that's how the bank got the money they needed for September. And now come November, they got the money that was due them for October.
Exactly. That's 100% accurate.
Love it. Man, Mike, my brain has been going 90 miles an hour with all the other questions and information that I want my viewers to know about mortgage, because I think the more they know, the better position they're going to be. But man, I feel like we've been on a little while here. So can I have you back again so that maybe we can touch on some more in-depth topics on more like specific areas of maybe debt to income ratios, or how to increase your FICO scores? I mean, these are just things that have been just,
Sure.
and I want to talk about this, I want to talk about that. But I think for right now, I think we've got a lot of good stuff out there, man, right?
Absolutely. What I always say to clients is, I don't want you to become such an expert, that you now need to join the loan business and start doing loans. You've got your job and this is my job. But there is a lot to know, and to be, as they say, knowledge is power. And it is good to be informed in the loan process. The more you know, the better you're going to be off in this. And I am more than happy, Tom, to share more info in the future. We'll keep going through this and keep letting your future home buyers know what to expect and get them to be homeowners. I
love it. So one last closing thing, Mike. What would you say? I'm young. I'm waiting tables, or I'm just, I'm in that millennial age. What advice would you give me to help get me ready for home ownership with a mortgage? Well, might be a tough question, but
but I mean, look, if you're renting, you're basically throwing money away. You get no tax benefits by renting. All of the greatest wealth ever created in the world has been related to real estate. They've always had that one thing in common. Doesn't matter if they invested in gold or silver, but they've always owned real estate. And some people go, well, is this the right time to buy, and this and that? Anytime you're renting and you can buy is the right time. To be a homeowner long term, when you look things out over 10 years, 20 years, 30 years, however long you go, owning real estate is always the best option. So if you're working out there waiting tables and doing things, maybe you've got 2 roommates right now and you're renting a place. You know what? Maybe you and your 2 roommates can get together and qualify for a loan and buy a house together. Put your resources together, own real estate. It's never been a better time. Rates are at the lowest we've seen in 30 years of me doing this, so pretty much ever. Right. And there's only one direction rates can go from here, which is up. So definitely put the resources together. Let's see if we can't get you qualified. And if not, at least we can put you on the path to homeownership down the road. Maybe it's 3, 6 months, a year down the road, but at least you'll know what you need to do now to be a homeowner in the future.
Mike, if there's anybody on this that would love to reach out to you and kind of check in on rates and stuff like that, how can they get a hold of you?
Sure. So our website, and you can see the name Lend to America, our website, www.lendtoamerica.com. That's one way, and you've got all of my contact info right there. And my mobile number is always the best way to reach me. And that number is area code 805-444-4294.
Love it. Mike, thank you again. I really appreciate you taking the time. I know you're a busy man. You, like me, are a father and son team out here in the business. So tell Ben I said hello, and let's get another one going soon. Yeah?
Absolutely.
I love it. All right. Thank you very much. And we will talk to you soon.
Thanks, Tom.
Bye-bye.